if you theoretically could build an index fund of tech startups in the US or in the EU, I would still buy the index fund of the US. And I would do that for a variety of reasons. One, the US market is equal to all of the EU combined, if not more. Its go-to-market is much easier in the US than it is across different countries because of internationalization and just complexities of being a multinational organization for an early stage startup. But do I think the
one
EU
language.
Exactly. Do I think the EU is going to do better on a relative basis to performances of the past? Most likely.
Our thesis is we like to talk to those companies and then acqui-hire the executive team that comes on board. We've done that twice. I'll probably do that a third or fourth time in the next 18 months, finding the really good people, new strategies, new ideas, and then bringing them on board, which has worked out well for us so far.
Fundamentally, a safe note has practically no shareholder rights. It doesn't have information rights. It doesn't have any governance rights. It doesn't have any pro rata rights. All it is basically a promise. You give me money, and if I sell this company for something else, you're going to get your share. What I do with the money, you have nothing to say with it. Just think about how absolutely stupid that method is.
And Bytes.
Hello. Good morning, good afternoon, everyone.
Good morning. Good morning.
Okay, James, like I said, I am behind the steering wheel today, so it's going to be a bumpy ride. Owen is not with us.
Nice. Strong intro.
Strong intro, yeah. How are things behind the pond in Germany? What's been going on?
How fab. How are you guys?
Good. Can't complain. I'm the surprise guest today, so good to see everybody's smiling faces.
No, you're not a surprise guest.
First good to have you back, Mike. Host, I guess.
You are our regular sub.
Day one of the newest government shutdown. Anything different for you guys?
When is it today?
Yeah.
No one?
It was this, September 30th, so yesterday. So day two.
Day two.
Yeah.
How long is it going to be for? I'm actually completely off the news, so I don't know.
No one knows.
Okay.
No one even knows what a government shutdown means. So how do we...
I think like 1.5 million employees will be furloughed. Or most of the time they'll get back pay once they have once the government comes back together. So it's obviously not ideal, but it's funny that driving or working in DC is a great time right now because no one's going to the office, so there's no traffic around the highway.
Nice.
But still doesn't sound like you're driving productivity.
No.
In the economy by doing so. Okay, so we've got a few things to go through today. So first off, we will go to EU startups or US startups. Which ones are, I don't know if there is the right way to put it, better, or which are on the better wave. Let's put it this way, maybe. Then we'll discuss startup founder Charlie Javis, who recently got sentenced to 7 years in prison for defrauding JPMorgan and being too creative about the numbers or just making up numbers. Then we have two guests, Alex Kraft, founder at HEAVE, on-demand heavy equipment service. They recently raised $7 million. Then we will go into Wissam Akra, CEO and founder at Tough Leaf, and we will be discussing recent Department of Transportation release in the United States and why is it impactful in the industry. So another one is EU startups are better, worse than US startups, and what does it really mean? So maybe I'll just give a little bit of background why I was inspired to touch on this one. Someone has wrote an article on LinkedIn, CEO of a company Upfront, which is about to be a unicorn, perhaps in end of year 2026. And in the last few weeks, since Germany actually announced infrastructure fund and that was infrastructure fund. The stock markets in the EU has been going up, and there was a environment that startups in the EU are going through the renaissance, etc., etc. Whereas I think that we've been in the EU quite sluggish in general and very focused on environment only, which was kind of checked by in 2022, since there was an issue between Russia and Ukraine. So
Issue? Really? That's where we're at? We're called an issue now?
Any issue, well, which impacted us, obviously, yeah. But
and I'm glad we're a non-political podcast, because otherwise I might have some comments here.
Okay. Well, I said issue. I didn't say.
I think it's so funny, the dynamics of the countries.
Yeah. So I'm just curious about what you guys think on the recent actually EU kind of statements. There's lots of people on LinkedIn were very bullish about EU, which I think that is actually, the people are bullish where there's more money, but where the money come from? Where does the money come from? From the fundamentals and non pun intended here, and from growth, which is driven by some sort of first principles, or by increased debt and money printing. So yeah, that's.
I have a few thoughts on this. If you theoretically could build an index fund of tech startups in the US or in the EU, I would still buy the index fund of the US.
Mm-hmm.
And I would do that for a variety of reasons. One, the US market is equal to all of the EU combined, if not more. Its go-to-market is much easier in the US than it is across different countries because of internationalization and just complexities of being a multinational organization for an early stage startup. But do I think the EU,
one language.
Exactly. Do I think the EU is going to do better on a relative basis to performances of the past? Most likely. So, but with investing, I think that everything is individualized. You find great businesses all over the world, and I'm sure that's Patric's job. It's like, I don't care where they are, they can be fantastic. And so there's going to be outliers in every single market, and that's going to continue. So I think the US relative lead might diminish, but from an index fund perspective, I would still bet on the US startup ecosystem, because for the last reason, the amount of private capital going into these businesses is tremendously more. And a lot of talk is from capital from other sources, which is never, I hate using the word never because it's very definitive, private capital is far superior than anything that's coming from governments in terms of creating growth.
Mm. And it's more of it now. Do you guys feel that there's lots of it still in the US, or there is more perhaps going out from the US to the EU, for example?
You mean in venture, or more like
venture?
General?
Yes, in general, I think in the public markets. Well, right now, I don't know. I think the public markets are all-time high again. Yeah?
So look, the US VC investors, with the start of the Ukraine war, Martin, let's not call it an issue, okay? It's not a little spat. It's a war.
I was trying to avoid being political, and said I didn't mention war because that can be picked up by YouTube algorithms and all of that. Yeah, and I said the issue.
Okay. So with that start, American VC investors looked to invest in the US more than they had previously done in Europe. Europe was a strong growth ground for US investors up until the end of 21, early 2022. They liked valuations at the time, blah, 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 but it was just an insanely liquid and over-liquid market anyway. Plus, America has the correct ambition to reindustrialize. We all know that, and that obviously has been an attractive reason to invest domestically. And that hasn't come back on the VC side of things to the degree that not even near the degree that we were before 2022. So if your question is about the private capital that is deployed via VC, then that is my answer. On the public side, I think we're seeing a complete different picture.
Okay.
Hey, Patric, just curious, like Dustin brought this up a little bit of like when we were building Connected, we had a very, very hard time expanding into the EU and London for not just language reasons, but just like different construction workflow reasons. In construction tech specifically, when you're evaluating companies, like how do you kind of stack that up against each other? It's like,
can I run with that question, Mike, and sort of mold it into my answer to Martin's hate speech question here? Okay.
Yes.
So
I'm European. I'm just trying to be honest.
No, I mean, you like to stir a little bit, but it's okay. It's okay. That's why we're here. So it depends on vintage and on strategy, and then the return expectation. I think you will always have a better chance to make a 10x VC fund if you either invest in emerging markets or the US. From the amplitude that you will achieve, emerging market first, US second, and then any other market, including the EU, third. You will have a better chance to make a 3x fund and let's say 15%, north of 15% net IRR in general in the EU versus the US. That's statistically proven across a 10-year period. In specific vintages, that will not be the case. In specific vintages, the US will outperform even without the amplitudes, but more of on a means basis, will outperform the EU. On others, the EU will outperform. But if you look at the entire 10-year period, typically the EU will have a slightly higher net IRR than the US. But that's also, and that's why I'm coming to the strategy, because in the EU, you have smaller funds.
I was going to say, I'm curious because like this, just spinning it back to AEC specifically, it seems like there are specific construction tech tools that have been successful.
Yeah, sorry, I didn't answer that. Yeah.
Like Israel to the United States from some like the capture, like the visual capture tools, but then like workflow tools, specifically, I'm thinking like Procore, for example, had a very, very hard time going into the EU, where AConnect started in Australia and like didn't really have that strong of embeddedness. And it seems like there are specific workflows or tooling or things that work across borders, but then like bid management is called tendering in Canada as an example. And you would be amazed at how much time Dustin had to spend changing bidding to tendering in Building Connected because of that just a little bit of like a terminology. And I'm curious, like, is across the board, like it just seems very complicated.
Thanks for reminding me, Mike. So let me now tie it why I came up with this strategy. Number one, if you make 100 million funds or less, you can be satisfied sometimes with a 250 million or 300 million outcome in one specific market. That's completely fine. The moment I have to deploy 250 million, one European market is never going to cut it anymore. And it is true. Once you develop software for our industry, it will be regionally specific. It sounds like you guys had the same experience. I can confirm it from my experience too. Now, where it's different is in transactional models. So I have seen models that are marketplaces or financial services scale much, much better because there you are selling the outcome and then it's less about terminology. It's actually about the value that you're providing. Hey, I'm financing you something. Here's working capital. Here is material. So there I don't see the boundaries.
Mm-hmm.
I actually wish our industry was a little more concerned with outcomes. And a lot of times I talk to customers and they get very lost between the forest and the trees. And like all they can see is this tree in front of them. Like we got this whole forest and we're focused on this one tree for some reason. But it really does actually hinder growth quite substantially. Because at the end of the day, whether you call it, to use Mike's example, because he was with me at Building Connected, do you care if it says tendering or bidding, or are you trying to get a response from this subcontractor on what they will do for the job?
Yeah, that's not focusing on the right thing. That's focusing on how things sound, not rather than what they are for. Yeah.
Well, let me tell you, I'm doing all of estimating, all of pre-con. There is little terminology picadillos that every single person has. And I'm like, why are we spending hours discussing this picadillo and not talking about how do we make the entire pre-construction workflow happen faster so projects get put in the ground? Nope, we're going to focus on this one little point.
Yeah, that is crazy.
Patric, what's like European capital for context startups? Where do you see the most startups coming from in Europe in construction?
The most or the highest quality, the most money? So do
you can touch on three of those actually. So quality, most money, And
so the most startups is probably heavily correlated really with capita. I would have to crunch the numbers for you, Martin, if you wanted a precise answer, but I would say anecdotally, it's pretty much correlated with country size and population. How do I now not get the hate speech from people in the comments section? I will just say I'm very Francophile. And I love my French companies very, very much. And that's a country that has produced for me great projects and great founders, followed by Germany. And there are outliers too there.
So that is
specific to the EU, because you only ask EU.
Okay, that's Paris then, right?
Most of the times, yeah.
Mm-hmm. Okay, well, guys, Dustin, you are in, I think, San Francisco, right? Mike, you are in New York?
I'm in Vancouver right now, but yes.
Okay, yeah, but day to day, where do you pay taxes? That's what I'm asking.
Unfortunately, California. Although maybe not soon, maybe not for a while.
Where are you
heard some rumors.
Where are you bringing construction to capital to in the US?
TBD, but I think my time in San Francisco is numbered.
Mm-hmm.
I heard New Orleans is nice.
Or some.
There's people trying to get me to go there. It's not happening.
Mike, any thoughts?
Where to live? I'm in Charleston.
No,
South
I mean,
Carolina.
where's the construction tech startups happening?
Yeah, I mean, I think there's a lot of capital going into space right now. Seems like a lot of AI bot chasing, but we'll see how that kind of plays out in market. Just like looking around, there's a big conference right now, which I guess Dustin, you're at that one. You're for Bluebeam. And just like looking around, like the people that are attending, the vendors, a lot of like AI chatbots on top of documents, which goes back to Patric's point of like, we do live in this like 2D document world, and how is that changing? It's gonna be interesting how it plays out. I think there's gonna be a lot of burnt capital. Our thesis is we like to talk to those companies and then acqui-hire the executive team that comes on board. We've done that twice. I'll probably do that a third or fourth time in the next 18 months, finding the really good people, new strategies, new ideas, and then bringing them on board, which has worked out well for us so far.
Yeah, that conference, Edify actually is a finalist in their pitch competition, which I think's funny because we're not actually pitching for capital. But I'm going to give a talk on the future of pre-construction at another conference I'm at in Vancouver today. And I'm going to have some controversial opinions, I think, for the entire room. Because what we're applying AI to is just, it's so boring. So much effort is going into how do we take these 2D sets of plans and extract quantities from them. And that's like the hype of the AI bubble for construction, or how do we extract data from specifications? And I don't think anyone realizes that all of that is the table stakes stuff that literally ChatGPT or Gemini is just going to open source, and it's going to be free and ubiquitous in 1 to 2 years. Drop a file into ChatGPT right now, and it's getting real close, and that model's never been optimized for it. So I think what we need to do is actually like, what is the future of AI going to enable? And so that's something I'm going to specifically talk about. And it has nothing to do with extracting quantities from 2D sets of drawings. It has to do with being able to effectively inform on the cost drivers of this project, so designs get outputted in something an owner can go out and build. I'm very bullish on the ability to use models with structured cost data to train them on here's how you can price a project, and then inform designers of what to go out and actually detail.
Is it not that these wrappers are like the first stage of the advancement within this space?
I don't think so.
This is no?
No, I think that you have to own the workflow of how data is generated and have an organizational structure that allows you to capture it and then execute on it. A lot of these people are starting with a model first, and they have no workflows around them. So I don't.
And you're seeing the pushback from some of the big GCs that are like Scanspan Turner are doing their own things around that, and they're building their own wrappers for that exact reason. They're like, hey, we have workflows, we have things internally. Why am I going to rely on a point solution to do a specific thing that I can go to ChatGPT to do, or go to a company like Reducto is a great data extraction tool for all industries that like can do exactly what I would say 99.9% of these, whatever you want to call it, AI chat agents, whatever you want to call it, Dustin, on top of these document extraction tools. which is fascinating because it's like, what's the moat? There's no moat there.
Yeah. What I found is when I get a project to called for from structural engineering point of view, and it's a hefty set of files with 20, 30 PDFs, lots of drawings, I just upload all of it in GPT and I prompt it properly, and probably 80% of the job scope is fairly accurate. So I'm actually very surprised that it has got to this level without I don't know how to like properly specifying the language model onto the construction space or into the design space. Yeah, it's absolutely remarkable, feels to me.
Mm-hmm. Martin, we spend 15 minutes together. I'll build you a Claude Code one that you can do that with instead of going to the normal ChatGPT that throttles data.
Okay, 6:50 p.m.
That's pretty cool.
Yeah, so that's for sure exciting. Okay, shall we? So we've got 6 minutes until the first guest. We've got perhaps two more subjects before that. So, Patric, do you want to touch about the valuations, or shall we go to the fraud?
Oh, let's take the juicy subject. Wait, which is that? No, the fraud.
The fraud. The fraud. Okay, so startup founder Charlie Javis, I guess, sentenced to 7 years in prison for defrauding JPMorgan Chase. I think this happened in 2002, 2020, 2023, and she had her startups and sold for 150 million to JPMorgan, and she made up several 100,000 of user base. I think that was the case. Yeah, Dustin, you brought this one up.
I have so many takes on it, but I think I want to take it's just so audacious that you thought you were going to go through an acquisition and that JPMorgan Chase, a financial institution, was never going to do a deep audit of every single data point you turned over to them and eventually discover this. That is a really, really bold assumption. But look, when you're running a startup, here is something for any founder, is that you cannot misrepresent your numbers because you are raising capital on, like, it has some level of performance, but it also has some level of faith and trust. And your ability to be trusted, because even if that startup doesn't work, the next one, if you're going to be in this ecosystem a while, you could never sacrifice that. But I know a lot of companies companies I have invested in that I have serious questions about their ethics. And the truth is, there is a lot of companies that raise capital, and I'm curious to hear Patric's. I have at least 2 companies that I've invested in that I actually think I've been frauded on, but there's no recourse for this. It's very hard to go after them unless I were to personally create a vendetta for them. So there is a problem here, and I actually think that it's unfortunate that only the ones get acquired shed light on it. There's a whole slew of people that can raise capital at the angel and even the seed rounds that are never going to see repercussions for it.
That's horrible. You can't really get any repercussions on this from investments point of view. It's obviously horrible that I see that so many times when companies are saying things which, when you start thinking about it, it just cannot be true, or is it like super colored version of the reality? And yeah, that probably touches on marketing a little bit, but
yeah. So to build on that, I think there's a line there between what I say I want to achieve, my ambition, there's certain plans, and misrepresenting what I have already achieved. So an example of the latter, Dustin, right, would be, classic one would be, I say my ARR is this and it's really that. And then I make an argument, yeah, but I meant contracted ARR or whatever. No, sorry, that's a term, right? Okay. Don't do that. If, however, a founder says, hey, I think in 3 months from now, my ARR is going to be that, we're getting into perhaps, and he knows he cannot or she cannot achieve that, whatever, then that's unethical. But I think that's from yeah, from a court perspective, perhaps they would say, okay, I mean, that you as an investor, you're a professional investor, you should know what you're doing, etc.
Yeah.
Many people would perhaps think it's not that, or whatever, right? And so I think there's that delineation. Personally, I have been critical of VC as an industry across markets where VC has been very liquid. So not just the US, all of the markets where VC is very liquid, where I think we have seen a perversion of what VC actually is enabling people to do. And by people, I mean both investors, because investors are sometimes defrauding their investors too. We have seen these cases, as well as founders. And so this perversion, you can see it in, let's do a bigger safe round. And by the way, safe round side letters, we don't need them. We can do it at the next round and just give me the money and basically trust me what I'm building with. I don't know if people realize, and Dustin, you have been far more outspoken on this than even I have on your opinion about safe notes. So let me just pile on that. Fundamentally, a safe note has practically no shareholder rights. It doesn't have information rights. It doesn't have any governance rights. It doesn't have any pro rata rights. All it is basically a promise. You give me money, and if I sell this company for something else, you're going to get your share. What I do with the money, you have nothing to say with it. Just think about how absolutely stupid that method is. That like that's, Mike, you come to me and you offer me money, and I tell you, thanks for believing in me, Mike. I'm gonna circle back in 18 months from now, and by then I will let you know what I did with your money. Like that's what a safe note is. And so this kind of instrument has it has contributed to the perversion of the venture industry a lot, I think.
So you're placing the blame on the founders or on the investors?
No, both of them. I mean, ultimately, I place the blame on someone completely different. I think the LPs are to be blamed, because if they give the industry money without actually thinking about how it should be deployed and setting the incentives correct, that's the perverted system that you're getting. Sorry, that was actually way more involved than I wanted.
I know you would agree with this. My mistakes are my mistakes. So the ones I've invested in that I have questions about, they're learning experiences for me. But this is also why what Patrick said about these safe notes, I'm actually so very staunchly against this vehicle that's been created and is perverse. I don't think the intent was ever to go to the level that it's gone to, but we have to pull it back. It is an absolute awful instrument from an investor perspective. And I think it's an awful instrument from a founder perspective because they do not have repercussions. They don't have performance obligations. There isn't debt tied to the business in the same way classical convertible notes were, where it was, hey, we get our money back in 18 to 24 months. You're carrying interest and things of those natures. So I've made some mistakes. I got money and I started deploying it because I wanted to learn. And I realized that those were mistakes that I was willing to tolerate. But I do think it's comical that JPMorgan actually went through a transaction and didn't pick it up during diligence. Like if I was JPMorgan, I would be looking at my M&A team and be like, what are you guys doing here?
Did they actually wire capital, or did this come?
Oh yeah.
So they closed the deal and then it's crazy. Wild.
I mean, we had fun during the pre-brief. Let me just say it. So during the pre-brief, we said there's 3 ways how you can make money building a business. You actually build a business and you become profitable and make cash flow. The second one is you go very, very far and you raise VC along the way. And then you make a big outcome. And the third one is you tell a great story and you take a lot of secondaries off the table. So
guys, I'm trying to find Alex, but he is not here.
There's a lot of secondaries going on in the AI space. Or making some money.
So
I think there was. I think they're stopping it. But there was some secondaries that were quite comical. I'm like, oh, that's a good outcome.
I mean, there's people are signing term sheets in like one day for billions of dollars of capital. It's like very limited due diligence. And that's the craziest thing is I just don't feel like it's I don't think it's changed. Nothing's changed since that announcement. You know what I mean? Like, all right, that happened in 2022. Is the market really that much different right now where buyers and sellers are actually having these conversations?
In some ways, Mike, I think actually what's happening in the AI part of the market in the last 36 months, it has been worse than in 2021 in some ways.
All right, guys, Alex is here, so we have to wrap that one up. Hey, Alex.
How's it going?
Very good.
Hey,
How
Alex.
are you doing?
Pretty good. How are you?
Yeah, very good. Very good. Yeah, congrats on the raise recently.
Thank you.
So you are the founder of HEAVE, is it? HEAVE?
Yep, HEAVE.
So as a structural engineer, HEAVE is obviously when the ground expands. That what was the reason behind the naming?
It wasn't my idea, but I think it was more of a play on like heavy equipment. And
okay.
if I think the unwritten rule for all tech companies, it has to be one syllable. It has to sound somewhat fresh. So I think it fit that criteria too.
Got it. So yeah, on-demand heavy equipment,
Mechanics. Yep.
actually mechanics.
Yep.
So you recently raised $7 million.
Yes.
Yeah. Congrats on that. Yeah. So tell us a little bit about HEAVE. Like, what do you guys do? Where you guys are at?
Sure. Yeah, we're on-demand heavy equipment mechanics. So we fix heavy equipment, repair like big, large excavators, wheel loaders, and we do it out on the customer job site. And it's done through, this is a new channel. If you were, legacy customers, they would have a machine break, and really you had one option. You'd call the cat dealer, you'd call the John Deere dealer. And what has existed for a long time is there's a tremendous backlog for available mechanics. So a common customer experience is my excavator breaks. I literally call a landline, or maybe I have a mobile number. And the answer I get 98% of the time is, okay, we're 2 weeks out.
4 weeks.
Yep. And as a customer, that is death. You've got a $400,000 machine that's just sitting there on a job site. You have a crew assigned to the machine. So you have now 6 to 8 people who are standing around that you're paying. And then,
or you get another one.
There's a domino effect. And so what I found, because I have 20 years of industry experience, what I found years ago was, because I worked at a dealership, I found really talented mechanics quitting. And my assumption was, when I found out, okay, the cat dealer paid him $5 more to hire him away from us. And when I started asking around, the answer was no, that person went independent. And I was like, interesting. Tell me more about that. And what was happening was the mechanics, and still are to this day, are grossly underpaid for their skill set. And I'm sure everyone on this call has seen this play out in plenty of other industries. We were paying them on the top end $40 an hour and billing them at $180, $200 an hour. And these mechanics who have all the leverage because they're in short supply in the market are like, I haven't had a raise in 12 months or 18 months. Why don't I go start my own business? Create an LLC. I already know the customers because I've been at the dealer for 8 to 10, 12 years or more. And so we built a business building the technology layer that provides visibility of all of these like former cat dealer mechanics to customers. And now technicians who are independent can earn market rate. So we have a lot of technicians on our app who are $140 an hour, $150 an hour. We add a markup on top, but the customer gets to pick from available mechanics that are close to them, and we show them their skills, we show them their background, their resume, where they used to.
So it's a marketplace for breakdowns, kind of.
It's a labor marketplace for heavy machinery repairs. And that's what we've been on a really fun ride. Raised a seed round in August of 2023, and have been growing consistently since.
I think that's wonderful. There just cannot be enough mechanics right now to service all the equipment. And there has to be market shortages in various localities that something like this could really help. Frankly, I'm surprised to hear that they were getting 40 an hour, because I always revert back to the damn elevator operator, mate. They bill those jobs at like something like several hundred an hour. When you
So,
think about the person
oh,
who needs to come service this equipment that's holding up the whole project, like pay that person to get this project going.
it makes no sense, right? And I need these reminders from time to time, because we'll like onboard a new mechanic and they'll be at like a higher rate. And then like I live in Tampa, Florida. I had a plumber house, they were like 300 an hour. And to your point, like,
Wow.
hey, if this person can fix a $500,000 excavator, like, and I pay a plumber 300 an hour, I still think there's room to grow because
There's definitely room.
yes, yeah. But it's been awesome because for both for a marketplace to work, and I know I'm not telling you anything you guys don't know, but it's got to win for everybody. And so customers win because they're getting speed, and also in the majority of cases, we're still cheaper. We're cheaper per hour versus the dealers. And then obviously we win by the volume and growing the business, and the technicians win huge. Like, we have 2 mechanics who are on pace to earn about 500,000 this year on our platform, which is mind blowing. I mean, they would have made 80 grand at a dealer.
Yeah.
That's
Also
wonderful.
in construction, if things need to be done quickly, people are happy to pay like super premium and on any type of service, engineering, architecture,
Correct.
and I guess in more like tangible stuff,
Yeah.
like repairing of the equipment.
Yeah, a common conversation around that in our industry is like, what is the cost of downtime? What is the
That's right.
the cost of the machine sitting around for a week? We have not tapped into that. Like, I'm sure people's minds start to go like, oh, surge pricing per se. But we haven't. We build a transaction, and we're in an antiquated industry that's done things one way for forever. And so we don't want to introduce friction. We just want to delight customers. And so that's what we've been focused on, and not kind of playing around with different models.
Hey, Alex, is there a thing like maintenance contracts that are tied to these yellow machines, etc., and how do they work? And specifically, for example, actually, Dustin, it's fun that you mentioned elevator industry. I have a bit of a background there, and that's typically when you sell an elevator for the first time, new installation, you typically get a 3-year maintenance contract, which gives you all the margin. It's not the installation. After that, the elevator maintenance contract gets retendered. Is that similar in equipment?
Yeah, so there are service agreements. They are not in the majority of sales. So there can be 2 different kinds of service agreements. So one service agreement can be specifically for what are called preventative maintenance services. So think of it as like oil changes, like the basic. So just like a car, you got to take your car in every 10,000 miles to get oil and fluids. In heavy equipment, everything's by hours. And so the service intervals are mapped out like every 500 hours, you have to have a service. So there are some of those, not with every machine. And there are also like what are called TM&R, total maintenance and repair agreements, that can be sold with machines. And similar of like, hey, a 3-year contract. And what it does is it offers like cost certainty for the customer. But the reason why these aren't that popular with customers is because the customers know that they're paying an inflated price with the dealer, and the response time is terrible. And so they don't want to enter into an agreement when the typical term, like, we're 2 to 3 weeks out. And so they want optionality, and they don't want to be tied into something that they know they're not getting the value from. And so that's kind of a sticking point. Why they're not more.
Sorry, one follow-up, guys. Alex, once you have density in a city, let's say Tampa, do you think at some point actually your customers will trust HEAVE enough to say, you know what, come on, Alex,
1,000,000%.
you get a maintenance contract?
That's one of the things that I'm excited to do. because we'll have, so the other thing, there's so many different like nuances to this. The other thing that's really powerful that we can do with service agreements is that we can service their entire fleet. We're brand agnostic. And so if you're a customer, you typically own 3 to 4 to 5 different brands of equipment. And so if you had a service agreement, you'd have a service agreement with 3 to 5 different dealers, which have different price points, which, the response times vary, and the overall experience varies. And so it's a really unique thing that we'll be able to say, hey, we'll give you a service agreement, but for all of your brands. And so many things to do there. Response time guarantees we can start offering. The transparency of cost, because we're collecting data on all different brands and the repairs. Like in the not too distant future, I could see us where a customer puts in a request and we show them, hey, that job ranges between low end, high end. And they've never experienced that kind of transparency, like at time of order. So there's a lot of different things that we can do that will benefit the customer.
Alex, I have a crazy question. Have you ever thought about
the last one, Dustin?
Have you ever thought about just changing the pricing model entirely? Because your value actually isn't to how many man hours the mechanic worked. Your value is how long was that equipment out of commission. So, hey, if we get you back up and running in 24 hours, $2,000. Like, who cares? If that equipment is critical path for the project, your price is actually correlated to the delay of the project. And to say, hey, no one else can do it, $2,000, we're having you up and running the next day. Because then you're not correlated to the man hours. Who cares if he's there for 15 minutes or 2 hours or 4 hours? Your price elasticity has to do with the delay that project is suffering. So like, I think that your pricing model cannot be tied to man hours. It has to be tied to delay of the project. Like if this is critical path, you are fundamental. Like that's my opinion.
That is a crazy
Agree
idea.
or disagree? Very, very quickly, Alex, because we need to move on to the next one. We'll get you on the full episode. So,
okay. So I'm sorry. I was. So this is just kind of like a pre-interview, I'm guessing.
No. It is a full. Full 15-minute slot.
Gotcha.
We can chat more on it. Well, let's have a conversation. I think that the pricing model can be more extensive.
Yeah. I mean,
your value is tied to that project delay.
Yeah, totally understand the point and the thought. I haven't thought of it because mainly it's, like I mentioned before, it's an old world industry. And that would be a shockwave to the customer that, the reason why we're having success today is that, yes, we're doing things differently, but we're not doing things in such a way where we've got to like completely reteach the customer how things are done. So there is a comfort level and a familiarity with how we're doing it. We're just doing it using different tools. Mm-hmm. That would be a tremendous educational challenge, I think. Sitting down with customers, and if it involves a whiteboard, I don't think our growth would be as fast as it is today.
Great.
No.
All right, guys, we need to move on now. So, Alex, thank you very much. We will get you on a full episode and we'll chat more about HEAVE. Okay.
Yeah. Thanks,
Thank
Alex.
you. Have a good
Thanks
day.
a lot.
You too.
Bye-bye.
I think that's a cool model.
Yeah. All right, Wissam is here.
I think it's a cool model that he has, but I think that there's some things he can do down the road that are even cooler.
Hey, Wissam. Sorry for keeping you waiting.
Hey, Wissam.
No worries, guys. Thanks for having me on board.
How are you doing? So I will leave the introduction to Dustin, maybe.
Yes. So Wissam, full disclosure, I actually sit on Tough Leaf's board, but I think Wissam, you should educate the market on what just happened with the Department of Transportation and how this is affecting a substantial component of all U.S. construction spend. So why don't you tell us about Tough Leaf and then tell us about what's going on?
Yeah, definitely. Thanks again for having me here today. Great to see some familiar faces. Hey, Mike, hope you're doing great.
Good to see you, buddy.
All right. That's. I'll first tell you about Tough Leaf. We're a construction technology company. We help our clients meet the compliance requirements when it comes to finding small, local, diverse businesses, onboarding them onto their projects, tracking their compliance throughout the pre-construction and construction phases. Been doing this since 2022. My background is in construction, so I've managed mega infrastructure development jobs for about 15 years, managed about $10 billion worth of projects. Second Avenue Subway here on the Upper East Side of Manhattan, Hampton Roads Bridge and Tunnel down Norfolk, Virginia, and so on. And that's really where the idea to Tough Leaf came to mind, because we found this space in the market that was really unserved. You could find subcontractors using, Building Connected as one of them, and Construct Connect and others. But there was really no way to find companies that are both certified and qualified to do the project. And that's how Tough Leaf was born.
Where's the name from? Where's the name from?
Tough Leaf. So we started during, it was 2021. So it was like COVID time, and it was everything was New York tough, this tough, that tough. And that's where the tough came from. And Leaf was to speak to the tenacity of the small, local, diverse businesses that they bend, but they don't break. So we wanted to, get away from like construct this, build that, no offense, Mike. and have like something that could be, something that our customers will remember.
Okay, cool. So what happened recently with Department of Transportation, and how does it impact folks in construction?
So DOT on September 30th, one day before the government shut down, this was like the most important thing that they had to do. They issued a new ordinance, basically changing how the DBE program works, or the Disadvantaged Business Enterprise program works, which really is a requirement on every DOT project across the country. It was the percentage of that contract had to go to DBE certified firms. And to become a DBE firm in the past, you need to prove that you are a gender or racial minority. So if you're a female-owned business or woman-owned business, you qualify to DBE. And if you're a minority-owned business, basically owned and operated by Hispanic, Black, Native American, Asian person, then you can qualify as a DBE as well. So that was the landscape before September 30th. About 20% on a national average of all of these highway bridge projects had to go to these types of businesses. So as with the change in the new administration, there was a new ordinance that came out to basically nullify all DBE certifications to date and change how you become a DBE. So right now, or going forward, it's no longer going to be based on your race or gender. It's really going to be based on your net worth, financial hardship, education levels, and things of that nature. So the new ordinance doesn't really specify how you can become a DBE. There's no like fast and hard rule yet. But it does specify that basically everyone who is a DBE business, which is today in the US more than 40,000 companies, need to recertify. And they can't reuse their race or gender to become a disadvantaged business. So that's the first part. The second part is, while they're recertifying, all of these goals and requirements are on hold, basically. So you can no longer, there's a 30-day review period. We'll see what the final ordinance will look like. But if this passes, you can no longer place fines on contractors, or you can no longer disqualify them for not meeting their DBE goal, because effectively there are no DBEs right now until they recertify. Once people recertify, then the goals will be back, will be back live, but there will be this period of like, no one knows what's going on. As with everything government related, we'll see where things end up. I'm sure there's going to be challenges to this ruling. It'll end up somewhere in the courts. We'll see. But, it's when I started a company in construction, I didn't imagine that I'm going to have to become, a government lobbying expert and follow up with all of these laws. But here we are.
That sounds like a reasonable change. Yeah. But so some funds or some opportunities given based on real metrics rather than kind of inborn features.
Yeah. It makes sense. I mean, you can look at some instances where these things were kind of taken advantage of. Very affluent people who come from a minority background, which, in a lot of people's opinions, and I think it makes sense, shouldn't be part of this program. So that I think there's a step in the right direction, but there's also a challenge of like, now what? Now we're in this phase where like things don't really make sense and people don't know what to do.
How does that differ between like markets? Like if this is a national government mandate, how did that change like the New York State DOT requirements for projects and capital and things like that?
That's a very interesting question. My answer right now is like, we'll see. Because if like specific states say like, hey, we're not going to go by this federal ordinance, things will end up in court. New York DOT might decide to like, okay, we're going to keep maintaining our goals and let's see what you're going to do about it. US DOT, Caltrans might do the same thing. And we saw that happen, right? Like when you look at what we serve the most is minority-owned businesses. You look at New York kept their MWBE programs, whereas Florida moved to small business programs. So like things will be, I think, up in the air, causing more confusion for everyone. And that's where us as StuffLeaf, being the experts in the space, we're providing the most value to our customers because we're looking at things like you've mentioned, Mike, at market by market level and understanding how things are changing in the actual contract. Because at the end of the day, you're going to need to follow your contract. And if there's no addenda or addendum to your contract, then you just got to keep doing what you're doing today.
I guess that doesn't change much in the construction tech landscape. In construction landscape, it does change. Perhaps the money change hands, but it doesn't impact much construction tech.
Well, it impacts ToughLeaf.
It impacts ToughLeaf. How does it impact you directly? Is it a good
impacts
impact?
Us, the general construction tech ecospace, maybe not my personal company will directly impact it. We've seen the impact of the new administration at the beginning of the year, where there was like this period of like, well, we don't know what's going on. We don't know what the requirements are. We don't know if this is like a real thing, if things are going to change. And that caused a lot of uncertainty in the market, where we had to basically change messaging. We had to put in webinars to educate our customers. They're like, hey, you still have these requirements that still your contracts, things didn't go away. And right now we're assuming the same thing is going to happen with this DBE program, right? So us as StuffLeaf, we need to be, this happened on Tuesday. So we're still in the process of gathering more details, talking to people in the field, both on the construction side and on the government side, and GC organizations to really understand the impact so that we can communicate it to our customers. But, about 20% of our business today comes from projects that have these DBE mandates. And, whether we like it or not, a very big reason why contractors are using us is because they want to be in compliance, right? They don't want to pay these fines. They don't want to pay these penalties and so on. So if these fines and penalties are taken away, and they're no longer a thing, it'll impact us in the short term, until they come back. So that would be an impact. We're looking at ways of how we're going to streamline this recertification process and how we're going to enable it to happen. So this might go from being, a headwind to us into more of a tailwind, because someone's going to have to build something very quickly in order to enable this recertification process for 41,000 plus subcontractors all across the country, looking at 50 different DOTs that have to comply with the federal DOT programs. We're definitely impacted, whether it's negative. I hope not. I hope it's going to actually be something that's positive for us as StuffLeaf and for the industry in general.
Okay. Last question for you. What made you decide to become a member or board member of ToughLeaf? What's so compelling about it?
Well, it's very related to everything we did at Building Connected with both invitation to bid and our qualification solution TradeTap. because when you're selecting these contractors based upon their certification, my internet seems, was I breaking up?
No, you're okay.
Okay. So it was very related to the things we did at Building Connected. So when Wissam approached me, I did know how extremely laborious this is for most large builders and for any project team. Even if you go through a qualification process, you have to go validate that these certifications are actually accurate and current. Some of them at like, they expire at different points of time. And so it was something we at Building Connected never did very well. We always talked about being the certification system of record because there isn't one. And so that's what I hope Tough Leaf can become. At the end of the day, at some point, there is going to be certifications because I do think that government needs a mechanism to help out new businesses come to market. I would rather it be more around socioeconomic status than some of these racial or gender identities. That's just a personal preference. But we do need mechanisms for new businesses to be created. It will create healthy competition. It'll create good competitive market landscapes. So there's always going to be this need to manage the process for the people who are buying from these companies. It's going to be interesting to see how it shakes out. I think that companies like Tough Leaf, though, can save companies a lot of money where they're not going to be properly staffed to manage. Hey, we need to recertify 41,000 businesses because we're a company that builds nationally. That's just not a thing. So it'll be interesting.
Okay. Wissam, do you see European or UK-based counterparts that do like vendor sourcing like you do?
We've seen some things in Europe, yes, but it also tends to be a little different, right? Like in Germany, there's 5%, I believe, that has to go to disabled-owned businesses. There are similar things in South Africa, for example, for minority-owned businesses. But all across what we're seeing a lot of interest in, all across, I would say, European, even Canadian markets, is the need for small and local businesses. And local is a very big factor here, right? Because you see a lot of jobs getting stalled, getting a lot of pushback, getting canceled because they don't get local support. And we're talking specifically about like these mega projects, right? Billions of dollars, data centers, and so on, because you go with like NIMBY, right? Not in my backyard. I don't want this. What do I gain from this? But if you're giving, part of the pie, a significant part of the pie to local businesses, you're going to get a lot of local support because these local businesses are employing local workers, local business owners. And then, I guess a big example for that, you can see what happened in Harlem with Columbia University. And full disclosure, I am a Columbia alumni, but they had a lot of pushback when they were trying to build their new campus in Harlem, right? Specifically for the nature of the area. But the way they were able to get around that was by dedicating, I think it was 30-something% to local businesses. And that helped that garner local support because now they're getting a piece of the pie, a piece of the construction, and more people are happy, and the project went through, and now the campus is built.
All right, Mike, Patrick, anything for Wissam?
Nothing to contribute.
Okay, Wissam, thank you very much for joining us.
Thank you.
Thanks for having me, guys. Take care. See you later.
Take care. Bye-bye. Cool. So we are almost at the end.
You still have a topic? That's why you say almost?
Almost at the end. We didn't say goodbye, so that's always the last word. Yeah.
I have something to share. I didn't realize it. Actually, Edify just turned 2 years old today. So
Congratulations.
Congrats.
I was
happy birthday.
And I can't announce the name, but we signed another national agreement with an ENR top 20. So actually we have 5 enterprise agreements with the ENR top 20 and just 2 years old. So
that means that you still have 15 seats are taken by your competitors.
Man, you talk like a board member now, Martin.
I want to see any other 2-year-old company that has 25% of the top 20 on enterprise national agreements. Seriously,
no.
it's pretty cool.
Congrats. Yeah.
Thanks, man.
I guess and hope these are at least mid six-figure contracts.
Yes.
CAR or daily? Yeah, CAR, not ARR.
CARR,
Yeah.
whatever you acronym you want to put to it. Yes.
What are these acronyms about?
So that's a whole other podcast conversation.
It's how startups financially engineer their fraud.
But they're not. Okay.
Martin,
Anything
you
else?
really have the hang of it. You should absolutely audition as independent board member in some of these companies. You really have the hang of it. You know,
Just
don't
send the
contribute, just
introductions
ask
to
for
your
targets.
portfolio. Send the introduction to your portfolio.
That's very
I'll do
ambitious.
that. I'll do that. I mean, simple question, simple answer. Yeah, I hope so. Okay. Anything else? Any business? Okay. That was another episode of Bricks, Bucks, and Bytes. This time, unfortunately, without Owen. He's enjoying his holidays. Yeah. So
Where is he? Like,
He is-
which part of the world?
he is in Turkey. Enjoying him. Okay, good. Thank you very much, gents.
Thank you, guys.
Thank you.
Talk to you soon.
Bricks, Bucks, and Bytes.